Roku is one of the most misunderstood tech companies on the planet. I get hundreds of comments about this company, and people are always making the same few points. Roku only makes money because of the pandemic, Roku has no real moat, and Roku is about to get crushed by Apple, or Amazon, or Google. These same people are quick to ignore the facts. Facts like Roku has been crushing Apple, and Amazon, and Google in the connected TV market for years now, since well before the pandemic began. Talk about the ultimate David and Goliath story. Instead, what everyone should be asking is how the heck a company over 100 times smaller than their competitors can be winning against these types of companies at all. To answer that, we need to answer a different question first. What does Roku do exactly? My name is Alex, and I'll answer both of those questions by taking a look at the science behind the stock. So what does Roku do exactly? It's easy to think of Roku as a hardware company that sells little boxes and dongles that power smart TVs, and then compare it to products like Google's Chromecast, Amazon's Fire Stick, and Apple TV. If you approach Roku from that angle, it feels like they're doomed to fail. After all, Amazon and Apple dominate every market that they're in today. Or do they? Just last quarter, Best Buy had to pull the Google-powered TVs made by TCL from their shelves because of, quote, challenges with the stability of the user interface and general slowness. After that happened, Google decided to lock in a multi-year deal with Roku to keep YouTube and YouTube TV on Roku's platform. That was a huge win for Roku, and it's just one recent example of the long-standing trend of Roku's dominance in the connected TV market. In fact, Roku isn't a small player in connected TVs at all. Roku commands almost 40% of all TV viewing time in the United States, and over 30% of that time around the world. That's 50% more than their next biggest competitor, which is Amazon Fire TV, and it's 6 times more than Apple's TV and Google's Chromecast. But that's not all. Around 4 out of every 9 connected TV ads go through Roku's devices, which is more than 3 times more than Amazon, Roku's next biggest competitor. Why is everyone advertising on Roku's platform so much more than anywhere else? The reason for Roku's dominance is the science behind the stock. What you need to realize is that Roku is a software company, not a hardware company. It's not about their devices. Roku uses their mountains of data from user registrations and streaming interactions to break audiences out into many different targeting segments for different kinds of ad campaigns. Roku uses machine learning to categorize users and content into certain groups and then matches them with only the most personalized and relevant ads. All the way back in 2019, data showed that Roku-only users were twice as likely to feel that ads on Roku were relevant to them compared to those who used Amazon Fire or Apple TV. The reason Roku is winning this race is the same reason that Tesla is winning the race for self-driving cars. Roku has a massive data lead that only compounds as they keep winning clicks. Okay, so they have proprietary data and algorithms that are great at matching ads to content and consumers, but that's only the first part of their moat. In order to get those ads and content in front of consumers, they need to get their operating system into as many homes as they can. You already know about their players, but what you should also know is that Roku licensed their operating systems to TV manufacturers like TCL and Sharp, kind of like how Google's Android is on phones built by Samsung and Motorola and so on. So Roku gets into a lot of homes without selling a dongle or box at all. So the next obvious question is, why would anyone want their TVs on Roku's operating system when they could have one built by Google or Apple? The answer is because Roku's operating system is designed specifically for TVs and their hardware, while Apple and Google and Amazon simply aren't trying to do that. Apple TV focuses on features that help it be a part of the larger Apple ecosystem, like working really well with an iPhone. Google's TV operating system is built on Android, not from the ground up for TVs, and Amazon's TV operating system is actually built on Android as well. Android works really well on smartphones and tablets. The problem is that TVs aren't built like smartphones and tablets. They have way less processing power and way less memory. They've never been the device to do the heavy lifting, and there's usually another device that does the work before sending the output to the TV, like an Xbox or a Nintendo. Roku's engineering team understands that, and their TV operating system is designed to use way less memory than competitors. That means Roku's operating system runs faster and smoother on the same TV, but it also means that Roku can work on less expensive TVs than their competitors. So TV manufacturers can build smart TVs for even cheaper if they use Roku's operating system, which means they can build more profitable TVs at the same price, or they can lower their prices to sell more units without eating into their profit margins. On the flip side, if Google wants smart TVs to make the most of Android's features, they need those TVs to have better chips in them, and better chips means more expensive. That's not necessarily a bad thing. Android has a ton of great features, and Google is amazing at quickly searching large libraries of content and recommending content to users. The real challenge here is that they're not able to do these things at cheap enough prices to compete with Roku in today's market, where consumer budgets are shrinking because of inflation and TV manufacturers are facing supply chain issues and chip shortages. This is why it's so important to stay up to date on the big picture, not just companies competing in one specific market. But it's not enough just to have the best prices. If you want to be successful over the long term, you need to be smart about where you put your money in order to grow. The sponsor for today's video is a great way to do just that. Public.com is an investing social network that I really feel brings together the best of both worlds. On the investing side, Public is free to use with no account minimum to get started, doesn't charge fees for standard trades, and allows you to buy slices of stocks for as little as $1. I'm just as excited about Public's community, where I've been able to share investment ideas with thousands of other like-minded, long-term focused investors like my article on Roku. So if you want to check out even more of the science behind these stocks, or you just want to know when I buy these stocks myself, consider joining the thousands of people already following me on Public.com. And whether you're looking for a new home for your own portfolio or you just want to support the channel, you can go to public.com/ticker-symbol-U and receive a free slice of stock worth up to $70 when you fund your account. I'll leave a link to that exclusive offer for you in the description below. Alright, let's talk about the future of Roku's business. Today, only 17% of Roku's revenue comes from hardware sales. Roku actually sells their streaming sticks and players at almost a 30% loss. Some of that loss is because they actually ate the costs of the chip shortage and supply chain issues instead of raising their prices for their customers. It's actually pretty normal in this industry to get in the door by selling a physical device at a loss, knowing you'll make that money up in digital sales down the road. For example, Microsoft sells the Xbox at a loss, knowing they'll make that money back with video games and Xbox Live subscriptions. Until recently, Sony was selling their PlayStation 5 at a loss for the same exact reasons. In Roku's case, this means selling the players and streaming sticks at a loss, knowing that they'll make way more money per user in the future with their ads. Roku's advertising business really has two parts: third-party inventory and first-party inventory. Third-party inventory is when Roku sells ad space on content belonging to a third party like Hulu or YouTube. Roku gets a percentage of the ad revenue from all of that content. On the flip side, first-party inventory is the ads that Roku displays on Roku's digital real estate, like their home screen or on the Roku channel. The Roku channel is where things get really interesting. The Roku channel is an aggregator publisher, kind of like Netflix. It gives smaller content publishers the ability to distribute and monetize their content on Roku. Like Netflix, Roku has also started acquiring and creating its own content. When you watch first-party content created and published by Roku, Roku keeps 100% of that ad revenue since there's no one else to split it with. Here's the thing. In my opinion, the next generation of all streaming video on demand will be this kind of content aggregation and cross-channel recommendation. Let me walk you through a more familiar example. When you watch one of my videos, YouTube will recommend other videos from my channel. If you like this video and subscribe to the channel, YouTube will recommend videos from similar channels based on what you just told YouTube you enjoy. Likewise, if you give this video a thumbs down, YouTube will show you less content from my channel and less similar content from other channels. That's pretty different from how traditional TV works today. They only show you content from their own channels as well as from direct partner channels with little to no input from you and no real information on who you are or what you're interested in. Over half of all TV hours watched are still on this legacy cable model. I'll get back to that in a minute. For now, let's take this example one step further. Google owns YouTube. If you go to Google TV, it recommends you content from across many different apps. For example, if a user liked Westworld on HBO, Google TV could recommend content from Disney+, Amazon Prime Video, or HBO Max, so it's making cross-service recommendations. You can also imagine seeing a recommendation for a service that you don't yet have. Hey, if you go subscribe to Netflix, you'd also be able to watch Altered Carbon, which we think you'd like because you liked Westworld on HBO. This is called a cross-sell, and it's a huge opportunity for aggregators. Think about how Amazon recommends you products while you shop, even from other stores. There's another big business opportunity for content aggregators, which is to let users build cross-service watch lists. So instead of having one watch list on Netflix, another watch list on Amazon Prime, and a third one on Disney, you only manage one watch list, one level higher, and the aggregator does the rest. This is a winner-takes-most market for content aggregators because the platform with the biggest number of users and the most data can make the best recommendations and therefore offer the best rates on advertising, which leads to better ad revenues and more content providers wanting to join the ecosystem. It's a powerful network effect for the aggregator specifically. And in my opinion, this shift will be the end of regular, unpersonalized cable TV. If the best and cheapest version of this smart TV experience is on Roku's operating system with Roku's ad matching algorithms on the Roku channel, guess where all the future cord cutters are going to end up? That's the big deal here. Okay, so at this point, we've covered the advantages of Roku's lower cost TV first operating system, their advertising and content matching algorithms, third party versus first party ads, the Roku channel, and the possible future of content aggregation. Let's make sure that the science behind the stock holds up by taking a quick look at their financials for 2021. Roku's total net revenue grew by 55% year over year to almost $2.8 billion. Platform revenue increased by a whopping 80% year over year to $2.3 billion. As a gut check, that also means that platform revenue represents over 80% of Roku's total revenue, so less than 20% of Roku's revenue is coming from their hardware. We want to see that trend keep going up. Active accounts reached 60 million users, which is a 17% increase in total accounts in 1 year. Streaming hours increased by almost 25% from 58.8 billion hours in 2020 to 73.2 billion hours in 2021. 25% growth might sound a little low, but it's actually almost double their streaming hours in 2019, right before the pandemic hit. So Roku is still growing even after all the growth from the pandemic. Here's the big one. Average revenue per user grew to $41, which is up 43% year over year. That's Roku's biggest year-over-year increase in average revenue per user since they went public. This is the benefit of having an ad-based model instead of a subscription one. Imagine if Netflix increased their subscription price by 43% in 1 year. Here are the two big issues that I see. In addition to player costs increasing because of supply chain issues, marketing costs are up 70% year over year. Both of these are issues that shareholders should be watching. Like I mentioned earlier, this is a winner-take-most market, and more households are cutting cable each and every year. So Roku is pushing its lead by acquiring as many users as they can, even at high customer acquisition costs. In my opinion, these costs are the biggest risks for Roku, not Amazon, not Apple, and not Google. But there is one tech giant that I think could absolutely crush Roku if it entered the connected TV market. And if you want to know who it is and why, check out this episode next. And if you feel I've earned it, hit those like and subscribe buttons to let me know that you enjoyed the science behind this stock. Either way, thanks for watching, and until next time, this is ticker symbol U. My name is Alex, reminding you that the best investment you can make is in you.